Howdy, everybody. Welcome to Liberty Call for Tuesday, February 11th, 2025. Hope everyone's having a fantastical day out there. It is cold and chilly here in Colorado. I last looked, it was 16 degrees outside, and it is freezing in my office today. So I got my hands trying to warm them up squishing them between my thighs, trying to stay warm. So anyways, hope you're having a great day out there. Markets are mixed today as investors digest Trump's new tariffs on steel and aluminum, while Fed Chair Jerome Powell signals no rush to cut interest rates, citing a strong economy and persistent inflation. Coca-Cola is bubbling up 3.7% after beating earnings expectations, but Tesla is down nearly 5% after Elon Musk's $97 billion bid for OpenAI was rejected. Treasury yields are rising post-Powell testimony, and oil prices are climbing on supply concerns from Russia and Iran. So before we dive in, I need some help from you. If you could give me some thumbs up, like, share, subscribe, and follow, and press the notification bell. All righty, well, let's get into today's markets. Dow Jones was up 0.29%, 130 points, closed at 44,600. S&P 500 up 0.07%, 4 points, closed at 6070. NASDAQ down 0.36%, 70 points, closed at 19,643. The VIX was up 0.89% today. It's at 1595. Canada down 0.11%, Brazil up 0.74%, and Mexico up 1.04%. In Europe, Germany was up 0.56%, the UK up 0.11%, France up 0.28%, Netherlands up 0.77%. In Spain, they were up 0.52%, Italy up 0.91%, Switzerland up 0.6%, and Portugal down 0.01%. In Russia, both exchanges were green, MOEX up 0.18%, RTSI up 1.2%. And the overnight markets, the Nikkei in Japan was up 0.06%, Australia up 0.01%, New Zealand up 0.91%. In China, the Shanghai was down 0.12%, Shenzhen Component down 0.69%, China A50 down a third, DJ Shanghai down 0.35%, Hang Seng down 1.06%, and the Taiwan weighted when it closed on the 10th was down 0.96%. All righty. Good stuff. So looks like the markets are kind of muted today. The tech-heavy NASDAQ was the one in the red. So not surprising. It's kind of been like that for a while. You know, the blue chips, which are your Dow, on the days they do well, the S&P is kind of in the middle. And then the NASDAQ or growth stocks is typically a laggard. And then it's kind of the reverse on days where the NASDAQ is, just jumping. Usually the Dow is, the biggest laggard. And again, the S&P is kind of that middle porridge in the middle of everything. All righty, let's get into the market recap. S&P 500 slips as Powell reiterates Fed's patient stance on further rate cuts. U.S. stocks edged lower on Tuesday, with the S&P 500 slipping as Federal Reserve Chairman Jerome Powell reiterated a cautious approach to interest rate cuts amid concerns that President Donald Trump's new tariffs could stoke inflation. In his testimony before the Senate Banking Committee, Powell emphasized that the Fed sees no urgency to cut rates, stating, quote, "With our policy stance now significantly less restrictive than it had been and the economy remaining strong, we do not need to adjust our policy stance," end quote. This reinforced the Fed's position from its January meeting, where rates were left unchanged. Treasury yields climbed following his remarks as expectations for a rate cut at the Fed's March meeting diminished. Powell is set to testify before Congress again on Wednesday, where he's expected to field questions about Trump's economic policies and their potential inflationary effects. Adding to market jitters, President Trump signed executive orders imposing 25% tariffs on steel and aluminum imports, eliminating previous exceptions for major exporters like Canada, Mexico, and Brazil. Trump hinted that these tariffs could increase and suggested additional duties on cars, semiconductors, and pharmaceuticals might follow. The president also signaled plans to align U.S. tariffs with those imposed by foreign countries on American goods, raising fears of escalating trade tensions. On the corporate front, Coca-Cola rose over 3% after surpassing fourth quarter profit and revenue expectations, buoyed by strong demand and higher prices. Shopify reported robust holiday sales driven by AI initiatives, but remains flat due to weak first quarter profit outlook. Marriott International fell over 5% following a disappointing 2025 profit forecast, impacted by underperformance in Greater China. Kellogg slightly declined despite beating earnings estimates as cost-cutting measures improved margins. All right, so that's that. Let's get to our next article here from Yahoo Finance. 3 reasons to dump the Magnificent Seven stocks. And for those who haven't been paying attention, the Magnificent Seven are basically, 7 growth stocks that have been just kicking butt the last couple of years with all the AI or money going into the AI space. So, all right, let's dive in. The once hot Magnificent Seven, Meta, Amazon, Google, Apple, NVIDIA, Microsoft, and Tesla are facing headwinds, prompting calls for reduced exposure. Adam Parker, CEO of how do you say that? Trivarate Research, advised in a note Tuesday that investors should reconsider their heavy allocations to these tech giants. So far in 2024, only Meta and Amazon, or I should say, so far in 2025, only Meta and Amazon have posted gains, with Meta achieving double-digit growth and Amazon up 5.2%, slightly outperforming the S&P 500's 3.5% rise. The remaining five, Alphabet, Apple, NVIDIA, Microsoft, and Tesla, are all down year to date, with Tesla the worst performer, dropping 17%. Parker cites three reasons for trimming exposure. First, Wall Street is increasingly scrutinized with massive capital expenditures on AI infrastructure. Meta, Microsoft, Amazon, and Alphabet are expected to spend a combined $325 billion this year, a 46% increase year over year, with Amazon alone projecting $104 billion, far above earlier estimates. Second, despite recent declines, these stocks remain expensively valued. The Magnificent Seven trade at a 42% premium relative to the rest of the S&P 500, near the upper end of their 25-year average. Third, the stocks are overowned. The Magnificent Seven make up 31.3% of market cap, but account for 44.7% of beta-adjusted exposure. Beta is the risk typically in a portfolio, meaning investors are holding them at market weight, have nearly half their portfolios tied up in these names. Adding to the risk is Wall Street bullishness. Only 4.8% of analyst ratings on these stocks are sell, signaling possible misalignment with reality. All right. So again, you don't want to put all your eggs in one basket. And when things are massively overvalued, again, you want to be careful. All right. Also from Yahoo Finance, Powell predicts a time when mortgages are impossible to get in parts of the U.S. So what's that mean? All right. Federal Reserve Chairman Jerome Powell warned Tuesday that the growing insurance crisis could make securing a mortgage increasingly difficult in certain parts of the U.S. over the next 10 to 15 years. Speaking during his semi-annual testimony to Congress, Powell highlighted how banks and insurance companies are pulling out of coastal and fire-prone areas deemed too risky due to escalating impact of climate change on natural disasters. Well, I'd say in the case of California over the last 2 months, it was arson and utility companies and their negligence negligence of taking care of the power cables. So, I mean, we had the same thing here happen in Colorado a few years ago. The utility company or the power lines set a big fire, which burned down a big section northwest of Denver. All right. Insurers like State Farm have been canceling policies in high-risk regions such as Pacific Palisades and Los Angeles, which later faced devastating wildfires. Since mortgage lenders typically require homeowners to carry insurance to qualify for a loan, prospective buyers in those areas are turning to state-backed insurers of last resort. However, these policies can come with higher premiums and less comprehensive coverage. Powell emphasized that banks and insurers won't continue offering loans or coverage in regions with mounting disaster risks. He also addressed housing affordability, noting that while interest rate normalization could ease some pressures, the core issue is the lack of housing supply, which is beyond the Fed's control. Even with lower rates, Powell suggested that housing inflation might persist due to increased demand. Regarding Fannie Mae and Freddie Mac, Powell stated that government backing helps lower mortgage rates, but the question of releasing them from the conservatorship is ultimately up to Congress. Well, I mean, the big problem back, 15, 20 years ago is that, the banking industry just, set aside all of their lending standards and allowed anyone with a pulse to get a house. So we know what happened there. All right. Last up, this comes from Zero Hedge. The penny, Treasury, and Asteroid drops. This is written by Michael Avery of Rabobank. All right. Mr. Avery of Rabobank delves into the complex interplay between of economic, geopolitical, and even cosmic uncertainties shaping today's world, highlighting how personal biases color interpretations of these events. The University of Michigan's consumer survey reflects this division, showing Democrats expecting inflation to rise while Republicans predict deflation, underscoring the polarized economic outlook. Adding a surreal twist, scientists report a 2.2% chance of an asteroid hitting Earth in 2032, a statistic most people dismiss, but one that looms large for those who grasp the catastrophic potential. Every every draws a parallel between the improbable yet devastating risk and the fragile state of the global economy, suggesting that as an asteroid can upend life on Earth, unexpected economic shocks could wreak havoc on the financial markets. Meanwhile, President Trump's 25% tariffs on steel and aluminum imports are disrupting global supply chains, particularly affecting Canada, Mexico, and Brazil. While these tariffs aim to boost U.S. manufacturing, they risk triggering counter-protectionism and inflation. A potential tariff carve-out for Australia, possibly tied to the AUKUS Defense Pact, hints at shifting geopolitical alliances with implications for Europe and NATO. Domestically, Trump's administration is reshaping federal operations, with IRS agents reportedly taking on immigration enforcement roles, while judicial pushbacks stall some of his aggressive policy moves. Abroad, Trump pressures Israel over hostage negotiations, threatening broader instability in the Middle East and the potential blockage of the Suez Canal. Financial markets, much like those contemplating the asteroid threat, are grappling with heightened uncertainty. Investors are torn between safe haven assets like the dollar and gold, while some turn to cryptocurrencies as hedges against systemic shocks. Federal Reserve Chair Jerome Powell's testimony to Congress is closely watched as concerns grow over Trump's policies, or that Trump's policies could stoke inflation, complicating the Fed's next move. Every concludes that by emphasizing that whether tariffs or asteroids, the world faces an era of unpredictable disruptions where traditional models may falter and adaptability becomes key. Yep. So whether or not it's an asteroid or some sort of a black swan in the financial world, there's something out there that's going to mess things up and cause a lot of chaos. We just don't know what it is, unfortunately. I'd put my money on financial carnage and an insolvency at the federal government as our biggest problem. But hey, that asteroid is still out there. All right. Well, that's everything I had to cover for today. If anyone needs anything from me, please go to DSAFinancialGroup.com. All your financial planning needs can be addressed there. So give me a buzz. I'd be happy to help. All right. Well, hope everyone out there has a wonderful evening, and I'll talk to everyone again next time.